Preparing for an investment interviews at ADQ Interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at ADQ? What attracts me to ADQ is the combination of institutional investing and real economic impact. It's not just deploying capital for short-term financial returns. It's building platforms across sectors like healthcare, food, logistics, energy, and financial services that matter to Abu Dhabi's long-term resilience. I like that the work requires investment discipline, portfolio thinking, and strategic judgment. That mix fits my interest in finance with a tangible development mandate. While answering, focus on ADQ's role as an Abu Dhabi-based investment and holding company, its long-term mandate, strategic sectors, national development angle, and why that mix fits your finance interests. Question 2. How is ADQ different from a traditional private equity fund? A traditional PE fund is usually closed-ended, raises third-party capital, and targets exits within a defined fund life. ADQ is different because it is a state-owned investment and holding company with a longer horizon and strategic mandate. Financial returns still matter, but investments can also support Abu Dhabi's economic diversification and critical sectors. That changes how I would think about value creation. Not only leverage and exit multiples, but resilience, platform building, and sustainable cash generation. Make sure to cover ownership structure, time horizon, source of capital, strategic mandate, sector focus, exit pressure, and how return objectives may include both financial and national development outcomes. Question 3. Walk me through how you would evaluate a new investment opportunity for ADQ. I would start with the investment thesis. Why this asset, why now, and why ADQ is a logical owner. Then I would assess the market size, competitive position, regulation, management team, financials, and cash flow quality. After that, I would build valuation using DCF, comparables, and transaction benchmarks. Finally, I would test downside scenarios and strategic fit, especially whether the asset strengthens ADQ's sector platforms or creates synergies across the portfolio. In your answer, talk about investment thesis, sector attractiveness, strategic fit, management quality, financial performance, valuation, downside protection, execution risks, and how the opportunity contributes to ADQ's broader portfolio. Question 4. Which ADQ sector do you find most interesting, and what investment theme would you highlight? I find food and agriculture especially interesting because food security is both a commercial and strategic priority for the region. A strong investment theme is controlled environment agriculture, supply chain integration, and distribution efficiency. The business case is not only higher local production, but reduced import dependency and better margin control. I would evaluate assets based on unit economics, water and energy intensity, scalability, and whether they can integrate with broader logistics or retail channels. Be sure to mention one relevant ADQ sector connected to a clear macro or regional trend, explain the business model appeal, and show how you would translate the theme into an investment thesis. Question 5. How would you value a private operating company that ADQ is considering acquiring? I would triangulate valuation rather than rely on one method. First, I would normalize earnings for one-offs, related party items, and working capital distortions. Then I would use trading comps and precedent transactions to frame market multiples. I would also build a DCF based on revenue growth, margins, CapEx, working capital, and terminal assumptions. The final view should reflect both standalone value and any strategic value ADQ can unlock through scale, governance, or portfolio synergies. While answering, focus on using multiple valuation methods, normalizing EBITDA or cash flows, assessing growth and margins, selecting comparable companies, building a DCF, and reconciling valuation with strategic value. Question 6. What are the most important assumptions in a DCF model? The biggest drivers are usually revenue growth, EBITDA margin, capital intensity, working capital, discount rate, and terminal value. In many DCFs, the terminal value can represent most of the enterprise value, so the terminal growth rate or exit multiple needs to be defensible. I would not present a single point valuation. I would build sensitivities around WACC, terminal assumptions, and operating performance to show the range of outcomes and where the valuation is most exposed. Make sure to cover revenue growth, margins, CapEx, working capital, tax, discount rate, terminal value, sensitivity analysis, and why small assumption changes can materially affect valuation. Question 7. Explain the difference between IRR and MOIC. Which is more useful for ADQ? IRR measures the annualized return, while MOIC measures total cash multiple on invested capital. A quick 1.5x return can show a high IRR, but it may create less absolute value than a 3.0x return over a longer period. For ADQ, I would look at both. IRR helps compare timing and efficiency of capital, while MOIC better captures long-term value creation, which matters when the mandate is patient and strategic. In your answer, define both metrics clearly, explain timing sensitivity, total value creation, reinvestment limitations, and why a long-term investor should look at both rather than optimizing one metric. Question 8. If an investment has modest financial returns but strong strategic value for Abu Dhabi, how would you analyze it? I would separate the financial case from the strategic case. The financial case should still be transparent: expected cash flows, downside risk, capital required, and return relative to alternatives. Then I would quantify strategic benefits where possible, such as supply security, job creation, localization, or ecosystem development. If returns are below market, the rationale must be explicit. Strong governance is important, so strategic value does not become an excuse for poor underwriting. Be sure to mention separating financial and strategic returns, quantifying measurable benefits where possible, testing opportunity cost, identifying risks, and creating a governance framework to avoid weak investment discipline. Question 9. How would you monitor the performance of a portfolio company after acquisition? I would monitor both financial and operating KPIs. Financially, I would track revenue growth, EBITDA margin, cash conversion, CapEx, working capital, and variance versus budget. Operationally, the KPIs depend on the sector, such as patient volumes in healthcare or utilization rates in logistics. I would also focus on governance, clear board reporting, management accountability, and early escalation of issues. The goal is to move from passive ownership to active value creation. While answering, focus on KPIs, budget versus actuals, cash generation, leverage, operational milestones, governance, management accountability, and using board reporting to identify issues early. Question 10. What due diligence workstreams would you run before recommending an investment? I would run diligence across commercial, financial, legal, tax, operational, regulatory, ESG, technology, and management workstreams. Commercial diligence tests market growth and competitive positioning. Financial diligence validates earnings quality, working capital, debt-like items, and cash flow. Legal and regulatory diligence identify ownership, licensing, and compliance risks. The key is not just collecting reports, it is translating findings into price adjustments, deal structure, protections, and a realistic value creation plan. Make sure to cover commercial, financial, tax, legal, operational, regulatory, ESG, technology, and management diligence, and explain how findings influence valuation, structure, conditions precedent, or post-acquisition planning. Question 11. How would higher interest rates affect ADQ's investment decisions? Higher rates affect both valuation and financing. In a DCF, a higher discount rate lowers present value, especially for long-duration growth assets. In leveraged transactions, debt becomes more expensive, reducing debt capacity and equity returns. Multiples can also compress as investors demand higher yields. For ADQ, I would focus on cash flow resilience, inflation pass-through, and balance sheet strength. Some sectors, like utilities or infrastructure, may hold up better if revenues are regulated or contracted. In your answer, talk about discount rates, financing costs, valuation multiples, leverage capacity, cash flow resilience, sector differences, and why long-duration assets become more sensitive when rates rise. Question 12. Pitch an investment idea that could fit ADQ's mandate. I would pitch a regional cold chain logistics platform. The thesis is that food security, pharma distribution, and e-commerce grocery growth all require reliable temperature-controlled infrastructure. ADQ would be a strong owner because it can connect the asset with food, healthcare, ports, and logistics ecosystems. Value creation could come from network expansion, technology-enabled routing, utilization improvement, and customer diversification. Key risks are CapEx intensity, energy costs, and execution. So valuation discipline would be critical. Be sure to present a concise thesis: sector fit, market tailwind, target characteristics, value creation levers, key risks, valuation discipline, and why ADQ has an ownership advantage. Question 13. How would you think about risk management in ADQ's portfolio? I would look at risk on two levels. At the asset level, I would assess leverage, cash flow volatility, customer concentration, regulatory exposure, and execution risk. At the portfolio level, I would examine concentration by sector, geography, currency, and macro sensitivity. Scenario analysis is important because sectors can be linked through common shocks like rates, energy prices, or supply chain disruption. Good risk management also requires governance, reporting discipline, and clear intervention triggers. While answering, focus on diversification, sector concentration, liquidity, leverage, currency exposure, geopolitical and regulatory risks, scenario analysis, governance controls, and the difference between asset level and portfolio level risk. Question 14. How should ESG and sustainability factor into ADQ's investment process? ESG should not be treated as a separate checklist. It should be integrated into underwriting and ownership. For ADQ, material ESG issues vary by sector: water and energy efficiency in agriculture, patient outcomes in healthcare, emissions in logistics, and governance across all assets. Strong ESG practices can reduce risk, lower costs, improve access to capital, and protect reputation. I would define measurable KPIs early and track them through the ownership period. Make sure to cover ESG as both risk management and value creation, sector-specific materiality, climate and resource efficiency, governance standards, measurement, and alignment with long-term institutional ownership. Question 15. Tell me about a time you had to make a recommendation with incomplete information. In situations with incomplete information, I try to separate what I know, what I assume, and what would change the decision. For example, if I lacked final market data, I would build a base case using available evidence, then run sensitivities around the uncertain drivers. I would communicate the recommendation with clear caveats and next steps. The important point is not pretending certainty exists. It is making a disciplined decision while highlighting the risks. In your answer, use a clear situation task action result structure. Show analytical judgment. Explain assumptions and sensitivities. Mention stakeholder communication. And demonstrate comfort making decisions under uncertainty. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.